Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode to the Ideal Investor Show, everybody. As you know, every so often we bring you some great guests to diversify, I guess I'm almost tending to say, from all the audios that you hear with my voice. And today we have a great guest. Arn Cenedella is with us. Arn, welcome to the show.
Yes, Axel, thanks for having me on the show. Looking forward to having a nice chat.
Absolutely. And I forgot to ask before, so did I say your last name reasonably well?
You got it really well. So 2 gold stars for you. That was good.
Before we go into more of the details, can you tell us, you mentioned before we started recording that you have a lot of experience, maybe for touching on the last 10, 15 years, what is the story of how did Arn end up doing what he's doing today?
I've basically been in the real estate business my entire adult life, got into it back in 1978, had the good fortune to sell residential property in the San Francisco Bay Area, down on the peninsula. Think Silicon Valley. My office was in Menlo Park in Palo Alto, California. Did that for 30 plus years, built a single family rental portfolio. And then about 10 years ago, left the Bay Area, moved clear across the country to Greenville, South Carolina, and transitioned my rental portfolio from single family homes to multifamily. And now most of my efforts are in the multifamily space as an investor and syndicator.
Okay, very cool. And so the single families, were those in the Bay Area or were they other places?
Fortunately, I got to the Bay Area when you could still buy single family rental houses. So during my career, they went from about $100,000 a bedroom to $1 million a bedroom. So I started buying rentals in the San Francisco Bay Area, had the good fortune to stumble into Austin, Texas around the year 2000. And of course, I'm sure most of your listeners understand what the Austin real estate market's been like. So did well there. So it was primarily Bay Area and Austin, Texas, until I moved to Greenville. And then I pretty much moved my entire portfolio to Greenville, South Carolina.
Okay, and when you discovered Austin, did you exchange from Bay Area to Austin or just add to it?
Both. So, so, the Bay Area houses had appreciated quite a bit, maybe not great cash flow vehicles. So I would be able to exchange one single family house into maybe 2 duplexes or a quad in Austin, Texas. And then, of course, I also just did direct purchases with cash that I had accumulated. But yes, very familiar with 1031s.
Okay, cool. And one quick question, just because I wrote about this recently. You said that you have this really long arch, which I'm very grateful to have you on the show because it's rare that I have somebody with that much experience in the same industry. When you're looking at all the things that are changing, right, like insane debt levels, yes, not 16% like in the 80s, but still for investing mortgages, something like 8% or so right now. But also, like all these things where when I went to school and looked at some economics classes, having highest stock market valuations, highest debt, comparatively higher inflation, no disposable income. Is this speculating, so to speak, on appreciation? You think this is still something that people should do, or how would you position that right now?
I don't mean to be negative, but the truth is the world financial structure, monetary structure could be called a house of cards. And, just let's call it as it is. Educated, informed people understand. And basically it all comes down to belief that the United States of America can pay its bills, which basically means it comes down, can the taxpayers of the U.S. keep things floating? As a kid, we had the gold standard.
Right.
Then we went to off the gold standard, and people said deficits matter. Now we have something called modern monetary theory, which kind of proposes as long as governments can print money, we're okay. Call me a little skeptical, I don't know. But to bring it back to your question, in an uncertain world, I think the way to minimize risk is to diversify your assets. That's the only way I figured out to do it. I'm a real estate guy. I would say I have 65% of my net worth in real estate. The rest is in the publicly traded stock market, mutual funds, and so on. I don't do any Bitcoin. I don't understand it. I don't invest in things that I don't. I think diversification is a key, both among different asset classes and also as you look to leave your W-2 or retire, create multiple income streams that can support you, because sometimes some will be up, some will be down. Now, in terms of real estate, fundamentally, in my life experience, the cost of real estate has increased, both for sale and for rent. And I don't really see any logical, rational reasons to believe that that's going to change. The cost of materials is going up. The cost of labor is going up. Population's growing. There's no more land. So I think just fundamentally, the cost of real estate, the value of real estate will increase. But of course, when you invest in real estate, you have to do it prudently, just like when you invest in anything. There's a way to do it prudently. There's a way to do it high wire act, swing from the fence, and maybe you hit a grand slam, but you're more likely to strike out. So I tend to aim for little line drive base hits, just consistent, safe returns over time. And it's done well with me, and that's how I kind of approach it, and with some diversification.
Yeah, absolutely. And it's kind of interesting because while I was listening, you were basically like almost quoting me, right? Because what I always say from a diversification is, and I have this as my portfolio basically, it's 65% real estate, 10% in stocks, about 10% in cash, and the other 10 to 15% in things like you were saying, like Bitcoin and some other collectibles and things like that. So it's very similar. One thing for our audience that I want to point out is not a critique on you, Arn, is I'm a little bit of a stickler, maybe because I'm originally from Germany and had to learn English as a second language, to pay very close attention to terms. So I totally agree with you that prices, or you could call them costs, have kept going up. And I also agree with you that they will be going up. I'm a little hesitant to also attach the word value to it, because I recently did a check, because I don't know if you ever heard about a guy named Keith Weinhold. He had that in his newsletter, and I saw it. I'm like, can that really be true? So what he did is, at the time, and you mentioned the gold standard, you could buy 1 kilogram gold bars basically. And so he looked at how many did you need to buy for the average house in New York or something like that in 1920, and and he could only find 1920. He tried to find 1924 but couldn't. So 1920 and 2024, and you need. So from a value perspective, if you had said, okay, I get myself these gold bars instead of buying a house, and kept them the whole 100 years, I'm not so sure that they really increased in any meaningful way, but the price obviously went from $9,000 to $400,000 in that 100-year span of time. I want to ask you a follow-up question, actually. What do you think, how much longer can we actually sell our debt to other people outside of the country?
Yeah, I don't know. It's a good question. How long can we continue on this path before there's some real problems? I think from a political point of view, the leaders would rather deal with inflation than depression. I think inflation is maybe not quite as painful as a depression. And to circle back to your point about gold and real estate, you are exactly right. And that's one of the other benefits with real estate. since it's a tangible asset, it tends to be a very good inflation hedge. So I agree, a lot of the numerical increase in the value is just a reflective of inflation. But of course, as investors, we want to be able to keep our nest egg going up with the rate of inflation, right? Because if we don't, then ultimately we're losing some wealth or purchasing power.
Right, absolutely. I'm totally with you on that. And I didn't really and don't really want to take this in any kind of political direction. The one thing that I'm personally afraid of, and I'm happy to share that with the audience and with you, Arn, is now I think we have started into an era, maybe not knowing because we have like 80-year-olds leading us, regardless which side, right? Where we actually forbidding some to have the same technology that we have. And I see really, and technology is moving so fast, and then not even talking about AI, I'm a little afraid that by starting to forbid access to certain things, that we could end up having a real bifurcation to an extent where you can't turn the screw back anymore. I see, for example, that in certain places around the world in real estate, they're now mandating that you, for example, put in heat pumps for heating and cooling. Like where you have individual units in every room and not what we are used to in our houses to have these central air conditioning units with pipes and you turn them on and they cool the whole house, even if you're just using 1 or 2 rooms. And where they're mandating that you have to be energy neutral. So there needs to be either insulation in your house, or you need to put a bunch of solar panels and a battery in the garage, and they already mandated that in 2030 or 2035 you can only have an electric car if you even want to own a car. All those kind of things pushing in a certain way for us as investors to ask ourselves, okay, what do we need to do to keep up with this so that we can actually maintain the right to rent out our properties, right? Because I see actually that there could be a scenario where regulations just say, if your house doesn't meet these building codes or building standards, you can't rent it anymore.
Yes, the retrofit regulations could be a little bit scary. And I think responsible property owners do want to make their homes more energy efficient. They want to be smart. They want to use the sustainable materials. I guess to me, it would be let the private market, let free enterprise decide that, right? Because if I have a rental house that has dual pane windows and Joe across the street doesn't, then theoretically I'm going to be at a competitive advantage because my resident's going to pay less. So I think that's more how positive progress happens as opposed to some imposition of some regulations, often by people who have no firsthand experience about what it actually means to run real estate. So it's an interesting question. And throughout the United States, you do see variations of the thing you are talking about. And again, perhaps companies and investors will vote with their feet the locations and areas that are maybe a little bit more reasonable may do better competitively against some areas that are more difficult to work with. So it'll be interesting to see how that plays out.
Yeah, absolutely. And I see it actually 2 directions. The one would be like, if I can offer somebody a house that has no electrical bill, renovation cycle, we put solar in and a battery in the garage. So obviously, you might be able to get a little bit extra rent for that if you say there is no electrical bill, and you can use any appliance to your heart's content. You're never gonna, run up the bills. And so those kinds of things where the competitive marketplace would say, whoever can do the best product for the best price gets the deal. I'm all for that. So now let's transition a little bit and tell the audience a little bit, what kind of syndications are you doing, offering? How can they be part of it? What makes them unique? That kind of stuff.
I'm in Greenville, South Carolina, which is the northwest part of the state. We're midway between Charlotte and Atlanta, which are recognized economic powerhouses. The interesting thing about Greenville is you has a major presence here. Every X car in the world BMW makes made in Greenville, Spartanburg, and Michelin has their North American headquarters here. We're on I-85, so it's a major interstate freeway, which is great. So I do smaller multifamily syndications, typically 30, 40, 50 unit buildings, maybe $3, $4, $5 million deals in Greenville County or in the upstate. It's about a 9 county region, million population, but it's growing rapidly. So we're very narrow geographic focused. My main business partner, my operational partner, is also here in Greenville. And I'm kind of an old school real estate investor. Location, location, location. Know your market. That's your competitive advantage. So I don't have properties in Phoenix or Boise, Idaho. I don't know those markets. So I only invest in markets that I know. So we do multifamily, and we have product from 1970s build all the way up to new construction. The last couple deals we've done have been new build duplex product. One, we like the new construction. In 10 years when we exit, we're still going to have new property, where a lot of the multifamily stock here is built 70s, 80s, so it's now 40 or 50 years old. And yes, you can fix it up, but you still have an aging structure. So we work with all investors, either accredited or sophisticated. We do the so-called 506B syndications. And since we do smaller acquisitions, we usually have a minimum investment of $25,000.
Okay, and then obviously the number of investors in the group is not that huge either, right?
We have 150 investors total. And I would say on most of our deals, 30 or 40 of that group invest in each deal. And when I talk to potential investors, I always say, if you have a sum of capital you can invest, don't go all in on one deal or one operator. Again, we're coming back to the diversification. If you have 200,000, put 50 here, 50 here, 50 there, test the waters and see how they perform, how you like it, and what they produce.
So on you said relatively new duplex or maybe also some more multifamily. How do they pencil out? Are they mainly on appreciation or a mix of appreciation and cash flows, or what would you say?
Yeah, good question. So with 7% debt, we're actually closing a deal today. Next week, we close another one on Tuesday. We're basically paying 7% for our debt. And so quite honestly, they don't produce a lot of cash flow right out of the gate. We are having to put about 40, 45% down. And what it will do is years 1 through 2, maybe we're getting a 3-4% cash flow, and it'll grow over time. We get fixed rate debt. All our deals are fixed rate debt. And the way I look at that cash flow is it's not so much to generate spendable cash. The level of cash flow is kind of that protective layer for the property, meaning if there's a little downturn, rent soften, there's some vacancy, the property's still self-supporting. So we like to go into a deal well capitalized, have ample cash reserves, get fixed rate debt. And if you do that, then time is on your side. So in my experience, the only time people have gotten hurt in real estate is if they get overextended, don't have cash reserves, run into a problem, and now they're up the creek without a paddle and have to sell in a down market. As long as you don't allow yourself to get in that situation, values could fluctuate a little bit, but if the property's cash flowing and supporting itself, you just keep running it. And long term, I won't use the word value, I'll say the price may go up. So that's how we kind of approach it. Yeah.
No, that's cool. And that totally makes sense. Now, when you said the debt and you found a lender that gives you 7% interest right now, going by what we hear from Jerome, are you limiting the duration for the debt, or are you just saying if I have to, or if the opportunity arises, I just refi?
This is 5-year fixed rate debt with no prepayment penalty. So we will be able to refi if and when rates drop. And I'd rather have 10-year debt with no prepay, but in general, that's not available. So the 5-year debt with no prepay allows us the opportunity to jump in. And just as an aside, as a real estate investor, I wouldn't plan on rates getting down to 3 or 4 again. My hope
right.
would
I agree with you.
right, if we could get low 5s, I'd be happy. People get caught up in the excitement, and everybody knew 3% was a historically low rate, but then somehow they started to believe historic means normal. No, right? By definition, historic is unusual. So no, you can't count on 3% debt. So that's how we structure it. It's with a local credit union. Generally on these smaller deals, it's usually like a local or regional bank or a smaller credit union. And then I think the point would be, if rates come down, we might then refinance into agency debt and set us up for another 7 to 10-year hold. At that point, we might be able to return some capital by increasing the loan amount in proportion to a decrease in the rate. Or if we keep the loan amount the same, then the cash flow goes up.
Exactly. Yeah, I'm only asking these questions because I've had recently spoken to somebody who said, okay, we normally always did fixed, like you just said, but for the first time we went with a 7/1 adjustable just because we think all the writing on the wall is not a risk to say, worst case, it's staying where it is, and then it's staying where it is, and that's what all our numbers are planned on. But if it starts coming down, then it will gradually help us over time. And if it somehow, for some crazy reason, I think you and I wouldn't expect it were to jump down, then you can still refi it.
Correct. And in financing, I'm talking about is 5 units and above. And so you can get a little better financing on single family or 2 to 4. And so, yeah, a product that might be fixed for 7 years and then go adjustable for 23, that's okay too. So I think the longer term's good. It's just good to have a little runway at a fixed rate and the no prepay, which allows you to get out if the opportunity arises.
Yeah, what he actually had was a 7/1 no prepay, like 1 year fixed and 7 years adjusted for prime. But if you say, okay, do I think that we might see something a little lower in a year from now? Maybe. But even if it takes another 2 years, then you basically 2 years straight, similar what we have now. And then I'm not saying it makes a huge difference unless there were some really crazy event that would take it down as fast as it went up. But I don't think anybody should speculate on it. I just thought it was an interesting idea to say, okay, if the expectation of either stable or lower is coming, then maybe that would be something to consider. If you break even and say, okay, how can we get at least a little bit of cash flow going, right? So
yeah, it's certainly a legitimate approach. It's interesting because to a large degree, the problem the residential market had in 07 or 08 was tied to adjustable rate, low down payment mortgages, kind of no qualification. And an analogous situation has developed in multifamily with this floating rate bridge debt. So floating adjustable's the same. And that bridge debt, the loan was made on what they thought the property could produce in 2 years after a value add. And so the money was lent on income that didn't exist at that time, which is similar to a residential loan where there was no documentation, no qualification. They were lending based on phantom income. So 2 different worlds, but fundamentally, I think the chickens came home to roost in a similar way, and now we're kind of working through it. So yeah, it'll be interesting to see what happens. I don't know.
Yeah, absolutely. And I don't know either. And so, I mean, if somebody says, why play around, just go fixed and see what happens in 5 years or 7 years from now, I totally with you. I just wanted to put it out there for the audience to realize if the environment is steady or trending down, there are a few more options. If you had done a 7-1 in late 2021, you would have basically screwed yourself, right? I mean, so it really depends on a close observation of what's going on and what is likely and what is the environment and so forth. And if you want to be on the safe side, just go fixed.
Correct. And then the other thing folks should look at, they should look at the index plus the margin to get their rate. So they then can get a sense of the magnitude. So if it's prime plus one, however they structure it, it's just good to understand what the index is and what the margin is. And then you have some awareness of what's the possible fluctuation. And again, if you could get 1 year fixed at 6 and then adjust versus paying 7, maybe the 6 1 year then adjust, assuming the index plus the margin added up to 7. If the index plus the margin added up to 9, I don't think I would do it, right? Because I think if you look at that, then you kind of get a sense of what the risk reward is.
Yeah, absolutely. And that's actually the thing, like I believe one thing you have to learn if you want to be longer term in real estate investing or investing in general is you got to get good with spreadsheets, right? And just plug in the numbers and see how they come out and act accordingly.
And the great thing about spreadsheets, where they're really useful to me, is you could adjust the input and see the result.
Right.
And so based on that, you really get an idea of what are the real critical factors to this investment. There may be some inputs that don't matter too much. There'll be other inputs that really impact those projected returns. And so it gives investors an inside look as to how this deal's actually operating and what's going to make it win or what's going to make it lose. So I really like the ability to do the what if, the sensitivity analysis. I find that very useful in making the decisions.
Absolutely. And we are the same again. So it's kind of cool that we met today and
Yes.
came together. All right. With all that being said, as I mentioned before we started recording, I always ask questions unrelated to investing at the end of each show. So the question is, if you could meet anybody, Arn, who would it be and why?
Well, how about Warren Buffett and just talk to him about his investing approach? And he still loves what he wants to do, right? And so I find that fascinating. I think human beings need to be productive. What's retirement these days? The definitions change. So I think he's kind of an interesting role model in terms of a long, productive life, but it's also something he really enjoys.
Exactly. I just looked it up. He's 93 now and seen multiple interviews with him where they asked him, how much longer do you work? And his answer, what do you mean I don't work? The reporter says, what do you mean you don't work? You're going to the office every day. And so he's saying, yeah, but that's not work. That's fun for me.
So I love doing real estate. I love working with investors. I feel passionate about it. My social and business life is intertwined. So my partners and investors are friends as well as business associates. And the way I look at it is productive activity that adds to the totality of my life. It's not work, and it's not work if you don't have to do it. And if you start investing in real estate, I promise 10, 15, 20 years, you're going to be work optional, and then you can decide whatever you want to do, travel the world, whatever you want to do. So being work optional, enjoying what you do makes a big difference.
Absolutely. I'm totally with you. And I'm saying the same things again to people that come in touch with me. So if somebody says, wow, that was a cool conversation, how can I join Arn's extended family? How do they get in touch with you?
Yes, so I'm very active on Facebook and LinkedIn. Too old to be an Instagram or a TikToker, so you can find me Facebook, LinkedIn. My website is investwithspark.com. I'm easy to find and always happy to talk.
Okay, well, that's wonderful. Thank you for your time, Arn, and thank you for all your wisdom. And maybe we can do it again sometime.
That would be great. It's been a pleasure meeting you, and I will reach out to you when we plan our trip to Spain. How's that?
Yeah, absolutely. That sounds good.
Okay, thanks, Axel.
Thank you.